Ladies and gentlemen, my name is Patrick Admoko. I am the Executive Secretary and the Chief Executive of the Association of Corporate Treasurers of Nigeria. On behalf of the Governing Council and members of the association, I wish to welcome you all to this webinar being hosted by the ACTN on the theme, the impact of discontinuation of Libor on the Nigerian financial markets. As usual, during the course of the presentation, or if you have any question or comment, we request you to kindly type your question or send your comments to the question and answer box, so that during this question and answer session, we'll be able to take your comments or questions as the case may be. Without wasting most of our time, we are typing this down. I would want to invite Mr. Zeal Akariwe, the president of the association, to kindly make his opening remarks, and we'll take it up from there. Thank you.
Good morning, everybody. On behalf of the Governing Council and the members of the ACTN, I wish to welcome you all on this webinar, which we've titled The Impact of the Discontinuation of Libor on the Nigerian financial markets. Libor has been in use, and I think most of us as corporate traders are very familiar with Libor as a reference and a benchmark for interest payable in financing almost all of our dollar-denominated transactions. The financial institutions in Nigeria are not left out. We borrow based on Libor, banks borrow based on Libor, then they on-lend to corporates based on Libor. Virtually every loan transaction, I think more than 95% of all loan transactions with any international counterparty is denominated using the Libor as the benchmark. Trading in the Nigerian capital market also uses Libor as its own reference rate. Now, it is very understandable that the manipulations that were revealed regarding Libor that led now to the phasing out of Libor would definitely have an impact on the financial markets in Nigeria. Now, with the global shift from Libor and its proposed phasing out this year, the question to the financial institutions and the corporates in Nigeria, which is what this webinar is all about, is what's the alternative rate that will be used for loan documentation? What's the impact of this phasing out, and what will be the impact on our financials and our books and our transactions with financial institutions on the new rates? Now, to put us through all of this, we're delighted to have Sarah Boyce. She's an Associate Director, Policy and Technical, Association of Corporate Treasurers of the United Kingdom, and she's also a member of the Sterling Risk-Free Rate Working Group, which is tasked with the transition away from sterling Libor to briefly review Libor, its discontinuation and the alternative reference or benchmark rate, as well as evaluate the possible impact of the new benchmark rates on existing contracts, especially in terms of profitability, cost, and risk management. So on that note, wish everyone fruitful discussion, and I hope we all, as the webinar goes on, please in the chat box send your questions so that as much as possible, because so we save time, we can bunch as many questions as we can together if they're all along the same line. So thank you very much, and welcome again to the webinar.
Thank you, Zeal. Our guest speaker today, as Zeal has rightly pointed out, is Sarah Boyce. Sarah Boyce is currently the Associate Director of Policy and Technical at the Association of Corporate Treasurers, United Kingdom. She starts with ensuring that members are kept informed about latest market developments and the policymakers are supported in the understanding of the real economy and corporate treasury matters in particular as they work through their own agenda. Sarah is a qualified accountant who spent over 2 decades working in a wide range of finance and treasury roles with large multinationals. She has extensive corporate experience and now spends her time putting that to practical use, enabling others to understand how the corporate financial world works and the relevance of developments in financial markets on the day-to-day activities of the real economy. Sarah is a member of the Sterling Risk-Free Rate Working Group. Tax will transition away from Libor and also sits on the non-financial corporate group in the U.S. Tax with supporting the U.S. Alternative Reference Rate Committee in the transition to RFR in the United States. It is my pleasure to invite Sarah to kindly share her thoughts on this subject matter. Thank you, Sarah.
Okay, thank you very much indeed. Thank you very much indeed to both Zeal and Patrick for the very kind welcome. I think that you all now know probably more about me than you strictly need to, but anyway, I'm really pleased to be here today. I think that talking about Libor is very important, and I think that what I would like to do is that we will, Patrick very kindly, due to the technology, will be sharing the slides from his end. So hopefully you can actually see the slides okay. What I was going to do today is talk very briefly a little bit about why Libor is disappearing. Perhaps if we move to the agenda slide, please, Patrick. Thank you. Okay, so so what I'm going to talk about is basically a little bit of scene setting around the problem with Libor, what the proposed solutions are, and really talk about how transition is going to impact everybody, what companies should be doing now. I'm aware that this is very much focused initially, at least from the corporate perspective, but actually it'll be relevant for financial institutions as well. So if we just very briefly look at the problem with Libor, which is the next slide, as everybody knows, basically the markets no longer function the way that they used to, particularly post all of the various regulations that have come into play since 2008 and the global financial crisis. And the basic problem with Libor is that the number of transactions in the market that reference Libor and therefore are used to calculate Libor have shrunk markedly. Arguably, they're in the low hundreds of millions daily, some days even lower. And the problem is that you then have a market which is over $200 trillion that's actually based on the very small number of Libor transactions. And really, that's really given rise to huge risk, and everybody's very aware about the manipulations and the mis-selling conduct and those sorts of problems that we've seen. And so really, this problem doesn't just apply to sterling, it applies to every currency. So for you in Nigeria, where you're predominantly dollars, and I'll touch more about what's happening in the dollar market later, and certainly if you have questions, please do ask them about the dollar market specifically, and I'll do my best to answer them. But this is a challenge that is facing everybody across the whole market. So having said what the problem is, on the next slide, a little bit about the proposed solutions and what is happening and when. So as everybody is probably aware, in July 2017, which feels like a long time ago now, but there we go, Andrew Bailey, who was at that time the CEO of the Financial Conduct Authority, which is the regulator of Libor, the IBA being based out of London, he publicly stated that banks would no longer be compelled to submit Libor after 2021. And the challenge was then about, well, what is Libor going to be replaced by? And the general consensus was that the best alternative would be to move to near risk-free rate benchmarks, which are generally referred to as RFR risk-free rates there. And the logic for moving towards RFRs is because they are much more robust, the underlying market is much bigger and deeper, and it felt that was a much safer benchmark than Libor going forward. They are being developed across all of the major currencies, And I think one of the things that's worth mentioning now, and we'll no doubt come back to several times, because actually it gives us as end users a number of challenges with this whole transition, is that all of the various currencies are moving at different paces, and they are moving to slightly different solutions. But the one overarching message is that everything that current references Libor will need to move away from Libor on or before cessation. And so then, just very briefly on the next slide, I've set out what's happening in the various markets around the world. And I think that these slides will be shared with you guys afterwards, so you don't really need to make notes as such. They'll be there if they're helpful to you. So as you can see from this, there's been a number of different approaches taken. People are on different timelines, but the one overarching consistency is that everybody has decided, every major jurisdiction has decided that a near risk-free rate is the most appropriate solution to transition away from Libor. And just as an aside, and one of the reasons that the risk-free rate has become so prevalent and, if you like, the solution, is because that the derivatives market, which is by and large, it's probably 4 or 5 times larger than what's referred to as the cash market, so the loans capital market part of the market. The derivatives market has become much more familiar and comfortable with, and to a large extent, was already operating with RFRs, and so it was a natural move for that market to move to RFRs. And then what's happened is the rest of the market has kind of moved along behind. One might argue that it's a little, certainly from the cash markets, for those that have got bonds or loans, it feels a little bit backwards, because actually an RFR doesn't necessarily work, and I'll talk about why, particularly well in those markets. But because the largest market is derivatives and it works well there, that's where the transition is moving towards. On the next slide, I've just very briefly, and I won't go into the detail, there's a lot of words on this, and you can all read it at leisure. A little detail about different currencies are moving at different speeds. The key things to remember is that the FCA as regulator have said that Libor is expected to cease from the end of 2021. There is, and what they mean by that is that, to all intents and purposes, there will be no Libor reference rate from that date. In the US, for a number of particular reasons, largely around how difficult they're finding transitions moving, they have made an announcement that it is possible that the US dollar Libor reference rate will still be published until June 2023, which is a further 18 months. But what I would say about that, before everybody gets all that's fine, we've got until 2023, let's all go home and drink coffee, is that the reference rate for dollars from the end of this year will only be used on legacy transactions. And I'll talk some more about new transactions, legacy transactions in a minute. But if you're thinking about doing new business after the end of this year, it will not, even if it's in dollars, the intention of the New York Fed, and they've been quite clear on this, is not to use Libor. It's to use an RFR, an alternate reference rate. So I think it's just worth emphasizing that point, because I know there's a lot in the media particularly saying, oh, we've now got until June 2023. Yeah, we have and we haven't, is the answer to that. So very quickly on the next slide, and this is referencing, this is a Sonia example, and I won't linger on it for long because I know that most of you are going to be much more interested in dollars, but actually the picture is similar in dollars. But basically what this is explaining is the fact that Libor and Sonia produce different rates. Libor and SOFR produce different rates. But what one finds is that the volatility that you see in Libor, and for example was particularly apparent in March and early on last year, you do not see the same in the RFR rates. They are much less volatile traditionally, and traditionally, not always, they are running lower than the Libor equivalent. And that's really because they don't include a term element and a credit element. Because the thing to remember about the RFRs, and one of the biggest challenges for corporates and people in the loans market and cash markets generally, is that the risk-free rate is an overnight reference rate and it's in arrears. So strictly speaking, you don't know what that interest is going to be until the following day, which, yeah, it's less than ideal if you think about it from a loans perspective. However, clearly the markets have cottoned onto that and have developed a number of solutions to work around that particular problem. Anyway, so having had a look at sort of a little bit of scene setting and where the markets are and a couple of the sort of key dates on timescales, I thought it might be helpful to spend 5 or 10 minutes just talking a little bit about considerations for corporates. So on the next slide, I've set out a few of the things that it's probably helpful to touch on. And really this is all about thinking, suggesting, if you like, a plan of approach to Libor transition. Sorry, excuse me. So I think the first thing, and obviously very important, is understanding the latest market developments. Clearly you can hear from people like me, and your bankers will become increasingly engaged in this and should be a very good source of information, but also the ARC and the RFR working group in the UK, the FCA. There's a number of really good sources of information which you can find on our websites, and we'll make sure that they're on the ACTN website as well. What's happening at the moment is that having the end of 2021 as a deadline has really focused the minds of the banks and the regulators in particular about how they're actually going to achieve these timelines. And I think until this year, there's been a lot of sort of thinking about it, talking about it, but it feels very much as though this is the year of action. And we're already seeing that a lot of banks are starting to come out to their clients and talk about what the changes are likely to mean, the alternate ways of working going forwards. Because, for example, as an aside, particularly in the US and in the US dollar and also in sterling, moving to SOFR or SONIA as the overnight rate is not the only alternative. It might be more appropriate for corporates to actually reference Fed funds, bank base, a fixed rate, given where the historically low interest rates are at the moment. So one of the things to consider is that one doesn't necessarily have to move from Libor to SOFR or SONIA. There are other alternatives. So I think that's a very long-winded way, and I apologise because I can get a bit long-winded and sidetracked. A long-winded way of saying, keeping up with the latest market developments and just trying to get across as much information and understand what all the alternatives are that are available to you before necessarily that you jump. I think that's going to save everybody a lot of sort of time, effort, and grief as we go through. So, having talked about the latest market developments, one of the key things I think for corporates really is talking about a bit of an internal audit and identifying where Libor might be in the organisation. And on the next slide, I'll talk a little bit about some suggestions about where you might find Libor within the treasury function or the finance function more generally. Clearly, this is almost the easier place to spot Libor. We're all very familiar with Libor appearing in our contracts, but places to particularly consider, or contracts, are particularly around trade finance and derivatives. And with derivatives and cash products, the thing to watch about is that if you have a derivative that is linked to your loan, for example, you need to make sure that they are both moving in step to a similar new reference rate, so that you don't lose hedge effectiveness. Whether that's economic or accounting effectiveness, you want, if you've got a derivative, you want it to be effective against the loan or the bond that you have it on. Other places to check, obviously, interest in cash pools. Intercompany loans is a very interesting one. It is causing quite a few headaches as we're working, as I said, working through this year of action that we're seeing at the moment. And particularly there, one of the big outstanding challenges is to do with the tax authorities and their treatment of loan pricing, intercompany loan pricing going forwards. If you don't have cross-border intercompany loans, it's probably less of an issue, but it's certainly worth bearing in mind if you're part of a multinational group in any way. So beyond the treasury function, finding Libor, and this is the next slide, it's very important, but becomes somewhat more challenging. And really, this is one of the areas that people need to give quite a lot of consideration to, how much focus they're going to place on changing Libor in these sorts of contracts. But what we would urge is that the first step is to actually identify where you have Libor embedded in these commercial contracts. And so that's going to be a case of talking to your procurement guys, suppliers, and just generally understanding where you might find these sorts of contracts. Late payment terms is a very common place to find Libor referenced in a contract. And beyond that, then we're talking more about the use of Libor perhaps in M&A transactions or in pensions, seeing it in performance measurement. I think really the purpose of this slide is just to remind people that Libor is not merely in the commercial operations, in the treasury operations, but it's in the commercial operations part of the business as well. And then finally, the next slide, there's some other considerations that really need to be taken into thought. Partly because, as I've said, this year everybody is now getting very much more focused on this, and there's a real risk that we're going to have a resource constraint between now and the end of the year. So, for example, if systems need updating, if you need legal assistance, if you need advisors, there are going to be a lot of corporates or a lot of institutions generally that are going to be asking the same people for assistance at a similar time. So it's really a case of making sure that you have a bit of a plan, and when you might want to have a plan and take into consideration the fact that people might not be available exactly when you want them. Just very quickly, I touched on accounting and tax on the previous slide, and I'll come back to it here just for a second, because obviously hedge accounting is very important for some organisations. One of the challenges that is spoken about quite widely when it comes to Libor transition is this about the transfer of value. And if we look just very briefly at the next slide, what we're talking about when we look at transfer of value, excuse me, is talking. The FCA, as the regulator, has been very clear that the transition from Libor to SOFR, SONIA, whatever it might be, needs to be economically neutral for all parties. So what they're very keen to ensure is that the banks in particular don't take advantage of this, and the costs end up being sitting in the corporate. Basically, they want things, just want it to be neutral. And so there's a lot of talk and thought that's gone into the concept of economic equivalence during transition. And this applies particularly when we're looking at the legacy deals that will need to be moved from, so existing deals that you have that mature after the end of 2021 that will need to be moved to a new reference rate. And the approach that they want to take is to make sure that, in this example, Libor plus the margin is exactly the same as SONIA or SOFR plus a credit adjustment spread plus the margin. And basically, there is a lot of work going on to make sure that the credit adjustment spread ensures economic equivalence. And when you are looking at transition, if either counterparty feels that they are going to be materially out of pocket, or if a trade is not being repriced like for like, then you absolutely need to push to ensure that you are achieving economic equivalence. So having talked a little bit about where we might find Libor, I think the next stage, well, I don't think, the next stage possibly, and the next slide, is really talking about making a plan about how you might want to attack Libor transition. So for new transactions, there are 2 or 3 things to think about. So selections of reference benchmark rate. As I've said, there are a number of alternatives beyond the obvious as SOFR, overnight in arrears. There are various in advanced rates. And actually, just here, I'll talk very briefly about term rates, because obviously for corporates, term rates are very they make good logical sense, let's put it like that, because they have the characteristics of Libor. They're forward-looking. You know at the beginning of the period what the rate is going to be at the end. However, the regulators, and this is in the US, the UK, everywhere, are very clear that they are very reluctant to have a term rate market of any scale. And what I mean by that is that they have a concern, and it's reasonable, that the liquidity in the SOFR and SONIA markets is very much at the short end. It's all in the overnight. And there is a risk that if you try and construct a term rate, it will have the same characteristics and therefore the same problems that happened with Libor, as in there will be very little liquidity, it'll be much less resilient, it'll be more at risk of being manipulated bluntly. So the short answer is the regulators do not want to go there. And they are very clear that term rate is something that should only be used in very limited circumstances. And that would be for things that require a discount rate most commonly. So some sorts of trade finance, some sorts of Islamic finance absolutely require some sort of a term rate, because otherwise those products simply don't function. But having said that, everything else, they want to move away from Libor and away from term. So that was my first bullet point on selection of benchmark rates. There is on new transactions, fallback language is important to keep in mind as well, because, and fallbacks, just to make sure that everybody is completely clear, when we talk about fallback language in this context, we're talking about the ability to move seamlessly, she says in inverted quotes, between the Libor or the current benchmark reference rate that you have and the post-Libor reference, let's call it post-Libor reference rate as well. And the switch mechanism that has been a lot of debate about recently actually enables that to happen automatically, either on a certain date or given a predetermined set of criteria. So that might be, so if you have a switch mechanic, it might say with effect from the 31st of December. It might be with effect from the first rollover date of the loan after the cessation of Libor. There's all sorts of language that one might include, but what it does is it means that you don't have to revisit the transaction and the documentation just because Libor has ceased to exist. And that's really important for both the banks and the corporates, partly because you don't want to be reopening contracts. For the banks, it's the sheer volume of contracts they'd have to revisit. For the corporates, every time you go back to a contract, there's always an opportunity or a chance, perhaps, that people will want to renegotiate terms that you've just negotiated and you really don't want to go there again. So to the extent that you can put clear language in new transactions, that puts that to bed, solves that particular problem. The final point I made just briefly on the new transactions is that when you're looking at bonds, loans and derivatives, they are all potentially, they can all move to slightly different conventions. So you just need to be very clear what market conventions you're adopting for which instruments, and make sure that that's going to work. To the extent, for example, that you want to hedge your loans or your bonds, you need to make sure that you have consistency across the piece. So it's really just a sort of a bit of a health check, a bit of a warning to make sure that people don't assume. One of the joys of Libor was that it was the same number, you used it everywhere, it was simple, everybody understood it, it was job done. Unfortunately, one of the consequences of transitioning to SOFR or to SONIA is that, or just away from Libor, is that the markets are going to fragment. And it's going to take a while for the banks and the financial institutions to come up with solutions that are consistent across products, across assets. So yes, please do just keep an eye to make sure that you've got consistency, and where you don't have consistency, that you're aware of it. On legacy transactions, there's a couple of things. We can break legacy down into two groups, if you like. You have those that it's possible to transition, and those which it isn't, which are referred to as tough legacy. And I'll come back to tough legacy in a minute, because that's quite an interesting and sticky little bucket. So the active transition are those that you can you can move from Libor to SOFR or SONIA, and then your debate really is about when do you want to do that. The regulators, and when I say regulators, I mean so I don't have to keep saying it, it's the Fed, the FCA, the ECB, they're all very keen that people actively transition. So what they want to see happening is legacy transactions moving away from Libor over the course of this year. The alternative is that it happens on cessation. So for the sake of an assumption, that's on a particular date. So let's say the 1st of January 2022. From a corporate perspective, active transition gives you more control of the process. So to the extent that you are comfortable with what you want to transition to, that you have the systems available, that you have the resources to transition, then we would suggest that actively transitioning is probably a preferable route for corporates, just because it gives you certainty. One of the challenges about waiting until cessation is you never quite know when that's going to happen. The markets may be very dislocated around that date, and it might just give, bluntly, more grief than you really need in your world. So that's active transition. Tough legacy, these are the deals that can't, for a number of reasons, can't automatically move to an alternate reference rate. And the best example of these are bonds or loans where you need 100% consent to make any changes to the contract. And for whatever reason, particularly with bonds, you can't find all of those bondholders, and therefore if nothing else happens, that contract will fall back to a fixed rate. Now, with interest rates where they are at the moment, a fixed rate might be attractive, but actually it's not the intention of that contract to be a fixed rate contract, and therefore is not ideal. The approach that's being taken to tough legacy.
Hasn't she moved from this slide? Still this slide.
Yeah. Can you see it?
Okay. Now that I was checking. Okay.
Yeah.
So you need to mute your speaker, Zil.
Okay. So with tough legacy, the approach that's being taken in every jurisdiction is one of legislation. So in New York, in the UK, in the EU, they are all working through legislation that will mean that for tough legacy contracts, and we can discuss we can't because I don't want to, but the exact definition of tough legacy is a work in progress. But for tough legacy contracts, there will be legislation, or the intention is that there will be legislation in place that means in the event of Libor cessation, these transactions will automatically have a waterfall that they will work through to get to a new reference rate. So that's tough legacy. Then on hedge effectiveness, I've mentioned hedge effectiveness already. It's definitely one to keep an eye on, and with legacy contracts. ISDA, I'm not sure how widely you guys will be using swaps, but to the extent that you've signed the ISDA protocol, or you have your swaps are referenced under ISDA, then it's a case of just making sure that the ISDA waterfall fallbacks is consistent with whatever you might have in your loan or your bond. And then finally on this slide, before I move on, there's very briefly on the non-financial markets activity. So this is the commercial contracts that I mentioned earlier, broadly. And really the question, and it's an open question, and we're seeing every sort of both approaches and mixed approaches, is whether or not you want to take an active or a passive approach to transitioning the commercial contracts away from Libor. A number of organisations that we're aware of, for example, where they have Libor in a late payment clause, have said, actually, we're just going to leave that contract alone, and we won't worry until or unless that late payment clause gets triggered, and at that point we will then have a conversation about the fact that it references Libor. And also, to be completely candid, I come from the corporate world. In my experience, a late payment clause would be Libor, but it would be Libor plus so many hundreds of basis points, or so many percent, that actually the margin over Libor is a much bigger number than Libor. So even if you set that to 0, it's the margin that gives you the biggest change. And then finally, you'll be pleased to hear, yes, I am nearly finally. So very briefly talk about communications challenge. I think this is something that it's very worth just touching on, because this is an area that certainly, as treasurers and financial professionals, sometimes we can get a little bit stuck in our own world, and Libor is such a huge difference, or huge change, and it's going to make it potentially a very big difference across the organisation. So it's really important to make sure, for example, that your board is aware of what's happening, the potential impact that's going to have on business strategy, on risk policies, possibly if there are delegated powers from the board to various other parts of the organisation, they may need revisiting. The board just needs to understand what is going on and what it might mean. Internal stakeholders obviously are important, and not just the finance guys. As we've already said, there's a lot of commercial contracts. Libor is endemic across organisations. You can find it in the pensions, in procurement, obviously in accounting and reporting. So it's a case of making sure that everybody is on side and is alive to identifying where Libor is. You know, as we all know from our risk management training, you know, you have to identify the risk to be able to manage the risk. And this is very much about identifying the risk. Talking about IT and systems very briefly, the systems guys are, now that we have, generally speaking, market conventions, systems providers are developing solutions, whether that's for treasury management systems or for bank systems. Clearly, the timing of implementation of those systems will be very important. So you just need to make sure that both your internal IT, but also your system providers are in a position and are joined up so that they can actually provide you with any support that you might need through that process. Relationship banks, as I mentioned earlier, banks this year are definitely getting engaged, but it's very helpful for them actually if corporates can go and actually ask about Libor. What are we moving away to? What does SOFR look like? What's, you know, how am I going to use that? Because it actually helps the banks identify the sorts of solutions that they need to be developing for the corporates. And then finally, you know, it's very important, as is always the thing with any, you know, any major change, talk about the a little bit about external stakeholders, the importance of keeping rating agencies on side in investor relations and investors generally. And this ties back to the board point, just that you know, this is an organisation-wide change potentially, and it will have impact potentially across the organisation. If you look at rating agencies, covenant compliance might be impacted by changes away from Libor. So do just think about you know, what that might mean, and as always with these people, you know, talk to them, keep them on side. And that's really all I was going to talk about today. There's a summary slide which is basically including the title, summarising the sorts of things that you might want to think about. But I'm very happy to take any questions if that's helpful. Or clarify anything, because I know that I can sort of wander off into the weeds a little bit. So please do say.
Thank you, Sarah. Thank you for a wonderful presentation. We'll move straight on to the question and answer session. And then to anchor that session is no other person than a member of the council and the founder of Interjet Supplies Management Limited, Mr. Funsho Shabande. He will take the answer and the question and answer sessions. So I hereby invite Mr. Funsho to kindly help us with the session. Thank you.
Right. Thank you very much, Patrick, and thank you very much for a lovely presentation, Sandra. We are truly enthralled by your presentation today, Sarah, and we think you've done the topic justice. I will start by just recapping a few of the points Sarah has made in the presentation before we go into the core question and answer. I think we all know why we're having this discussion. Libor has been one of the most popular indices that have been used, even though there are several other interbank offered rates in existence. We know that because of the manipulations, etc., that Libor was fraught with, that a decision had been taken to phase it out by the end of 2021. And that's because also coming out of the global financial crisis of 2007, 2008, the number of transactions between banks on which Libor was based has fallen dramatically. We're also aware that the FCA stated that firms needed to end their reliance on Libor by the end of 2021. And since the announcement of the discontinuation, there have been several questions as to how this will impact the Nigerian financial market, which is wholly dependent on the Libor rate for its foreign currency, interdenominated loans, and for derivative trading. Questions have been asked around what would happen to market participants that have exposures to the contracts with terms beyond 2021 that are benchmarked to Libor, as well as the need to identify alternative reference or benchmark rates. And Sarah has mentioned the move towards the adoption of RFRs and the risk-free rate equivalents, and evaluating the possible impact of these new rates on existing contracts in terms of their profitability and perhaps additional costs they would pose to hedging and so on and so forth. So the bottom line is that the financial industry must adopt a new benchmark rate by that time. 4 pertinent questions, or 4 to 5 pertinent questions, generally come to mind at this point. And we're hoping that at the end of this Q&A session, that Sarah would have thoroughly done justice to all the questions that are raised in this segment. So the first has to do with how might this change affect, the Libor referencing products in terms of liquidity, volatility, and the performance of investments, and also modifications to contracts. Second thing we'd like questions around is, what are the real alternatives that exist? Sarah mentioned the SOFR, that's the secured overnight financing rate, which is supposed to replace the US dollar Libor. There are also other indices like the Reformed Sterling Overnight Index Average, which is the SONIA she also spoke about, which replaces the British Pound Libor. With one issue I know with the SOFR is that there are no forward rates in the SOFR, and many financial instruments will likely face challenges when they try to calculate fair market value after the change. Then what will or what should happen, or actually what is happening from now until the transition, the end of 2021? She did mention legal provisions called fallback language that would ensure that contracts switch from Libor to a new rate when the Libor ends. There are some challenges with the fallback language because in existing contracts, they may not have foreseen Libor coming to an end. And I know that there is an existence of a few groups coordinating inputs from different financial institutions towards establishing some kind of consistency in the fallback language to standardize it across markets for differentiated products. The fourth one has to do with how exactly are the regulators responding? What alternative reference rates, are they being prescriptive? And do they understand the impact of changes that would happen? How should the companies themselves respond? You have given some ideas of that. And then what opportunities do we see emerging as a consequence? There could be opportunities in there for new product development, et cetera, and so on and so forth. And most importantly, what challenges or problems do we foresee? And you did start to touch on the issue with legislation and jurisdiction and so on and so forth. In particular, where you made reference to the point where for bondholders especially, there needs to be 100% agreement in terms of what they're moving to. And given the situation with interest rates at the moment in the market, it seems that the rates would favor a borrower more than it would favor the lender because of where the rates are presently. How do we expect that to degenerate into some kind of legal tussle? How are those things going to be resolved? So I think, with that, I just set the tone for the question and answer session. I haven't seen any questions on the chat window, but if you would like to address any I have raised right now, it's a good point for presentation. You touched on everything we expected you would touch on. Thank you very much.
That's okay. I think that so I just make it from all of those comments and questions. I'll make a couple of comments, and perhaps you can ask me some more questions if I don't answer. So when it comes to how the regulators are responding, and how companies are responding and how banks are responding. I think that it's been quite. There's been a very different approach between what's been happening within a jurisdiction and across jurisdictions. So if we look at, I'll take the UK, but actually it's very similar in the US as well. So in the UK and the US, they put in place working groups very early on in 2017 that were made up of regulators, banks, trade associations, corporates, so representatives from all parts of the market to try and work through the challenges that they knew were coming. Where one of the challenges, well, one of the gaps, if you like, has been international coordination. And one of the biggest problems, and to be candid, one of the most frustrating things, and it's frustrating for us as a trade association, for corporates and for banks as well, is that the lack of perceived lack, the regulators like to say perceived lack, it's lack of international coordination has meant that the different currencies have come up with slightly different solutions, and that the different jurisdictions are on slightly different timelines. And what that means is that even now, as we're going, arguably we're 8 or 9 months away from the end of Libor, there are still products that are being developed. There are still market conventions that are being established, and that makes life very difficult for everybody, because understandably, a bank doesn't want to develop a product until it knows what the market conventions are. A corporate doesn't want to buy it, and a systems provider doesn't want to write a system to manage it. But everything gets slightly circular, and this, I think this is partly as a result of the fact that, and this is my view, not necessarily the official view, is the fact that because this has been driven very much by the derivatives market, the initial focus and decisions that were actually made before 2017 about moving the derivatives market away from Libor made perfect sense for that market. The RFRs work in the derivatives market. The challenge is that they made that decision and then they thought, oh, well, what do we do about the rest of the market? And how do we solve that problem? And the decision was taken, well, we just make them all move to the RFRs as well. Now, it has become very clear that for large parts of the market, an overnight reference rate that's backward looking does not solve, just doesn't suit the market. Either the borrower isn't that sophisticated, it doesn't want to hedge, that it doesn't give the sort of certainty that Libor gives. And so what's been happening in the last few months is that we are beginning to see a growing number of alternative reference rate solutions, benchmark rate solutions. So I think somebody you mentioned the development of indices. Yes, there are a couple of indices both in the US and in the UK that are being published by the official sector. It's an alternative. I think our slight nervousness, my slight nervousness would be that it's not, corporates don't like to use something until there's a lot of liquidity in that market. I think that the challenge that the indices face is that that's not a particularly liquid market. It's quite difficult to see how it's going to evolve at this stage. And so I suspect that for a lot of corporates, they will want to move to something that is more familiar. So either has greater liquidity or is just more similar to something they've used historically. And so, for example, in the UK, and I reference the UK a lot just because they're further progressed than the other jurisdictions at the moment. It's not because the other jurisdictions don't have solutions, but there's so little liquidity, for example, in the US, that it's very difficult to talk about what we're really seeing happening in the US at this stage. Ironically, it probably needs another 6 months before you can say, okay, most people that need a US dollar borrowing are going to A, B, or C. In the UK, what we're seeing is that for a lot of the smaller borrowers, they are actually looking at using some sort of bank base rate. rather so a bit like the Fed base, Fed funds in the US, because actually that gives them the characteristics that they want. And I think it's worth remembering as a corporate and also as a bank that moving away from Libor does not automatically mean that you have to move to an RFR. There are alternative benchmarks out there, some of which might be more appropriate either for you as the borrower or for the bank for your clients. So it's definitely something to consider. So that was very long-winded a way of saying internationally they're all a little bit disparate. We could do with a bit more coordination. They are working. They recognise the challenge. You know, it's quite easy to say, well, I wouldn't have done it like that. But you kind of have to say, well, we're here. We need to get to there. How are we going to do it? Rather than say, well, that's just rubbish, because that's not helpful. We are where we are, and it's very much a case of having to get. We all have to get through this, and it's a case of trying to make sure that we all get through it as painlessly as possible.
Okay, Sarah, in your work group, likely to be addressed, between a borrower and a lender, trying to settle on a reference rate for a particular contract when they have a different bias. How is that likely to be resolved?
The regulators are very keen to make sure that there is not a mis-selling scandal of any description out of the back of this Libor. We've seen it with Libors, we've seen it in the UK and in the US with swap selling. The regulators are very alive to that risk, and they have spent a lot of time talking to the banks in those jurisdictions about conduct risk and about how important it is to make sure that the bank is offering something that is appropriate for the corporate. So it has to be a two-way conversation. I think that what we're very keen to do is to make sure that corporates, as far as possible, understand what's available to them and understand what might work best for them.
Yeah.
And then it's a case of the banks being able to support that solution. But equally, the banks will be very nervous, for example, they should be very nervous of offering or selling a loan that references something very complicated, whatever that very complicated might be, to a borrower that actually does not need something that complicated. It's a bit like selling somebody, I don't know, a Ferrari when actually all they need is a Ford pickup. You just need,
the issue about cost product appropriateness. That's what it is. Some due diligence around product appropriateness.
Yes. But it's beholden on both sides, I think I'd say as well. Absolutely the banks need to make sure that they are offering appropriate product, but the corporate needs to also really think about, well, what do I want? What am I achieving here? What is my objective? And because I know there can be a temptation to, aspire to something more than is actually required. So you're exactly right. Product appropriateness is absolutely key in this, and being confident that you understand what it is that you want.
Now, I know you did touch on the issue with the tax treatment, etc. But I just wanted to know whether for example, the IFRS, the International Accounting Standards, and the other standards that are in place in various jurisdictions are also being carried along in these work groups concerning, the treatment of whatever new contracts are adopted in various. Are they being carried along?
Yes. So carried along is a really good description. Actually, that's exactly what is happening. So the IFRS we're given two challenges. One was how to ensure that legacy transactions, as they transitioned, retained hedge effectiveness. And the other challenge was what to do in a post-Libor world. So I think possibly the easier one to solve is what to do in a post-Libor world. That's relatively straightforward. So what they're doing is they're working on making sure that their guidance works if you have RFRs. the bigger challenge was about making sure that hedge effectiveness is retained as you work through transition. And they have come out with guidance that basically provides forbearance to ensure that if you have something that's an accounting hedge before Libor transition, it is an accounting hedge after Libor transition. And that's the very sort of high level summary. If you look at the IFRS statements, you will probably just want to go and drink a beer or have a cry, depending on eat chocolate, whatever your preference is, because it's incredibly complicated. It's very, very detailed. And what I would suggest is that where you are hedge accounting, that you look at the guidance that the accountancy firms are now beginning to put out on the subject. So the big four, the PwCs, the KPMGs, etc., are all beginning to put out guidance. It's also available, it should be available from the accounting, so the Chartered Institute of Accountants should also be able to offer you guidance. It is very much that support, that instruction, that information is only now really coming out. I'm still sitting on calls with some very big brains from the IFRS and the various accounting firms who are beating out, and the banks as well, who are beating through the various languages that are coming out of the accounting bodies, just to try and make sure that it makes sense and what it actually means in practice. Because the challenge, as all of us who have ever read an IFRS statement know, the minute that you get down beyond the introductory paragraph, it suddenly gets very complicated, and there's a lot down to interpretation. Sorry, that was a very long way of me saying they're getting there. They're getting there. They're very alive to it, and they are absolutely working on it. And that's FASB, the IFRS, across the piece. They recognise that this is one of many. This is a challenge.
Okay, so we kind of expect that a number of clients would be taking their lead from the guidance that's published by the so-called Big Four, in terms of like the KPMGs and A&Co. So somebody asks the question: is it the individual banks that will end up determining the benchmark?
No. So talking about how the benchmark is calculated.
No, I think it's who decides which benchmark will apply.
Okay. Yes. So I think, as I said before, it's very much up to the corporate. If you have a view, if you want to use bank base, or if you want to use SOFA in arrears, or something else, as long as it's one of the regular, something that's not particularly weird, she says, for want of a better phrase, but if it's something possible, then there is no reason why you should not be asking for that. The ultimate decision, I suspect, yes, it will be down to the bank. If the bank said, I don't think that that's the right product for you, then the lender and the borrower are going to have a conversation about why the borrower thinks that is the right product. But yeah, so I think it's going to be a conversation. But what we're seeing happening in the UK, and as an example, because they're further down the line, what we're seeing happening in the UK is that the banks, partly because they're very aware of the conduct risk challenge, they are actually recommending, by and large, the right solution for the right corporate. So, for example, for the smallest corporates, they are already moving a lot of them onto bank base, because actually that works nicely for those smallest corporates. The corporates are happy, the banks are happy, the regulators are happy. So I think that there will be the very largest corporates that will want to use SOFA overnight, because that's what is most liquid, is what the market as a whole is using. So the very largest corporations, so for example, a Shell in the UK, BP, somebody like that, will be using the SOFA, because actually that works for them. They have that sophistication. Where the challenge is going to lie is where you have the corporates in between the two, and that way it's very much going to be on a case-by-case basis as to whether or not you as the corporate or you as the bank feel the SOFA or the bank base or something else, which is the better solution for that corporate in particular. But it won't be a case of, right, let me say Barclays Bank, it wouldn't be Barclays Bank, but Barclays Bank would not come out and say, okay, everybody has to take bank based. That won't happen. It's going to be a much more, but this is one of the unintended consequences, is the market will end up being fragmented as a result.
Yeah, but don't you think that don't you think things would be better handled if the regulator was a bit more prescriptive in terms of, I think if you are in this product, in this jurisdiction, you have X, Y, Z as your choices and no more. Mm. Don't you think it would be a smoother transition if, that sort of approach were adopted? I know it sounds like imposing restrictions, but I think that way they're all better prepared. And you put up a very interesting slide, which was that one about the equivalence. I think it was a slide where you put up the FCA guide on moving from Libor to SONIA.
Yeah.
And you pointed out that it should be as close to being economically neutral as possible.
Yep.
And I think that if that was done for a particular product where the customer or the bank just had to elect and say, okay, based on option ABC, we're choosing option A for this product, and the transition just happens. Mm. Don't you think that would be a better approach?
The only problem with that approach is that you always have people who don't feel they fit into a particular bucket. So it's one of those, you can't please everybody. And also the regulators are, for reasons best known to the regulator, if I'm completely honest, and this is not just the FCA, but we're seeing it everywhere, they are very keen for it to be a commercial conversation. So for the banks and the corporates, or the borrowers and the lenders, the market to be having the conversation. The regulators we are only seeing the regulators getting involved where there are problems arising. So for example, in the UK, we are currently seeing regulators putting themselves in the middle of transactions, syndicated loans,
right?
Where some banks think that solution A should be used, other banks think solution B should be used, and the corporate is just getting bluntly very cross. So the regulator is now talking to that syndicate to make sure that actually they all get to the right answer. The right answer being, well, in every case we've heard of, the one that the corporate wanted. But yeah, there's one of the challenges that we're seeing over here is that not only are corporates at different stages of preparedness, but banks are too. So some banks are absolutely ready to offer alternative products. Other banks are not. They're struggling still to get there. Now, I was just saying that so where the regulators have been getting involved with the syndicated loans, they have been coming out very much on the side of what the corporate is perceiving to be needed, rather than what some of the banks have wanted. Because some banks are very prepared and are absolutely ready, and other banks are quite a long way down the curve still, and are really not ready to offer alternative products even now.
Okay, thank you very much. Somebody asks a question: how will the hedges work? How are the various hedge products? and I know that's like a question coming out of a jack in the box because there are so many possible solutions. But I don't know if you want to give that a shot.
Well, very, very briefly, they're going to work the way they work at present. I think the big thing to watch for, if you have a loan and a derivative, is that the market conventions might be slightly different. So, for example, the number of days after the end of the period, or the lag that you have, so the number of days that you look back on your interest rate when you're calculating your interest, might be different on a loan and derivative. So you'll just need to make sure that to the extent they're not consistent, that doesn't impact your hedge effectiveness. to be honest, and this sounds like I'm dipping the question, and I kind of am. It's really more of a question for your auditors and your accountants as to what they're going to be prepared to accept as an accounting hedge going forwards. And as I mentioned, they are very much still working through that process and trying to understand what the IFRS are guiding them towards.
Okay, thank you very much for that, Sarah. This is more of a comment, an observation that you might want to comment on. In terms of the response by companies, corporates will need to alter all their financial instruments, including loans that refer to an interbank offered rate, by replacing it with the appropriate non-interbank offered rate by the beginning of 2022. And you have alluded to the fact that the switch would raise some complicated processes and data-related issues that companies will need to address. And just to cite an example, a company that has an interbank offered rate-based contract will need to engage the internal stakeholders, that's the treasury, legal, tax, and IT professionals. They would need to identify all the financial agreements and set a remediation strategy in place, as well as set consistent approaches for all the relevant contracts, and then document the procedures and results to be followed. Isn't that a bit, how would you prescribe that companies complicated to make sure everybody, and we all arrive at the same destination successfully?
Yes, you broke up a little bit there, but I think you're asking me about how everybody gets there. And I do you know what? I think it's really difficult, and we're very dependent. But this is where the banks can play such a large role, because actually these are their clients, and where we can have these conversations, and it's really great to talk to you and your colleagues. But the banks have a huge role in the education to make sure that companies that don't get caught by, aren't members of the various treasury associations or even the various accounting associations, actually understand what is happening, so that they can move in an orderly fashion as well. We're spending a lot of our time now in the UK actually thinking about how do you reach the, if you like, the smallest of organizations, the smallest businesses that might still have Libor, but will be completely unaware that this change is going on. Because as the comment said, there's a huge piece of work to do potentially. Now, clearly, if you only have one contract referencing Libor, it's a lot smaller piece of work than if you've got 5 or 6 loans which all have derivatives against them. Or if you're a bank and you have thousands, your loan book is thousands of transactions. So there's a question of scale. But yes, I think that we are very alive to the fact, and by we, I mean everybody that's been working on these things, about how do you make sure that the whole community that uses Libor is aware of this change. And it's really difficult.
Okay, Sarah,
sorry, I was just going to say, because it's not exciting. You won't see it in the headline.
Okay, I think my final question that I'd like you to comment on has to do with the fact that since we're all transitioning to some form of alternative reference rates, right? In terms of the depth or liquidity in the market for those reference rates, do we foresee a situation where, in a bid for corporates or the banks to hedge themselves, they cause the same sort of distortion that may lead to some of those reference rates becoming unstable, for use for which they were meant?
Yeah, no, and I think that's one of the reasons. It's a very good question, and actually takes us neatly back to why this is happening in the first place, and also the reason that the RFRs have been chosen almost exclusively in all of the various jurisdictions, and that is because that is the most liquid market. And the
Right.
regulators are most comfortable that if people are basing the reference rates on the most liquid market, then by the sheer size of the market, it's much more difficult to manipulate. It's much more difficult to random act to result in volatility. I mean, everybody knows how Libor spikes. Every now and then it just does something absolutely crazy for 24 hours. And part of that is because of the lack of liquidity. In the new markets or the new reference rates, it's absolutely, as I said, that's why they've chosen them, because they are, and equally that is why they are very keen for people not to use term, because they are much more nervous that as you go up the curve, that the liquidity dries up to such an extent that, in shorthand, you may have similar problems to the ones that we've experienced previously. So.
Okay, thank you very much, Sarah. I think it's been wonderful having you here today. That is, we've been hearing from Sarah Boyce, Associate Director, Policy and Technical Association of the Corporate Treasurers United Kingdom. She's also a member of the Sterling Risk-Free Rate Working Group, tasked with the transition away from the pound sterling Libor. It's been nice having you today. We've benefited from sharing that presentation with us. And I believe we've exhausted most of the questions, and we've also run out of time. So without much ado, I'll hand over to somebody to give the vote of thanks. Thank you very much, Sarah.
Thank you. Thank you for the questions.
Clarifications. I'll drop you an email or something. Thank you.
Thank you very much, Mr. Sholande, for well articulating that segment. And thank you, Sarah, for answering all those questions. At this point, as Mr. Shomade said, our time is well spent. I would want to invite the head corporate finance and treasury of Lafarge Africa and a member of the governing council of the association, Mrs. Victory Olumiyiwa, to kindly give the vote of thanks and bring the meeting to a close.
Thank you very much. Thank you very much, Patrick. And Kunshwa, thank you very much. We appreciate your session. You actually helped us to be able to throw more light into the topic being discussed. So on behalf of the Governing Council of the Association of Corporate Treasurers of Nigeria, as well as its member, we want to say thank you to you, Sarah. We know too well that you are capable of handling this session, and we would say that you've done justice to the topic. Thank you very, very much. And what you've done is actually to whet our appetite. Now, a lot of us are thinking of how do we go back to meet our legal team to begin to review the document, the legacy transaction, the need to engage various banks, and the need to now have an engagement with our external auditors in preparation for the year-end audits, because all of this would be coming up. Thank you very much. We say thank you to you, and I hope and I'm sure that you are prepared to take further questions, because like Mr. Kunsha Shobande had said, we will be reaching out to you because we know our members have a lot of questions that time would not permit us to take. So we'll reach out to you for further clarification, and thank you so much for the organization you represent. We thank you for the support and for the education you often provide to us. Thank you very much. We appreciate you. This is a time well spent. Thank you.
Thank you very much.
And to our members, we say thank you for joining us. We appreciate your time. Thank you. And have a very good day, everyone.
Thank you.
Stay safe.
Thank you, everybody. Have a nice rest of the day.